Tokenization is more than just a digital representation of money and assets. It involves digital representation on a programmable platform, which means that tokens can incorporate the rules and logic governing transfers, as well as the information about the asset itself. Now, currently, money and other claims reside in separate databases that are connected through third-party messaging systems, meaning that transactions need to be reconciled separately before being settled with finality. Tokenization makes all this one seamless operation. Tokenization is well suited to resolve incentive information problems. Think of an example where a buyer would like to pay when the goods are delivered, while the seller would like to deliver the goods when the buyer pays. Tokenization can solve this problem by executing both transactions at the same time. Two real-world applications discussed in the chapter are resolving foreign exchange settlement risk and unlocking supply chain finance. A unified ledger with CBDCs can make full use of the ability of central bank money to knit together diverse elements of the financial system. In this sense, the full potential of tokenization can be harnessed by having central bank money reside on the same venue as other tokenized claims.
Breaking news straight out of the Bank for International Settlements. We have blueprint for the future monetary system, improving the old, enabling the new. So what you just saw there was Huan Song Shin. He is leading this kind of unified ledger. And this is the same guy that had did another report, I believe it was last year, talking about this same thing. So key takeaways. Tokenization of money and assets has great potential, but initiatives to date have taken place in silos without access to central bank money and the foundation of trust it provides. A new type of financial market infrastructure, a unified ledger, could capture the full benefits of tokenization by combining central bank money, tokenized deposits, and tokenized assets on a programmable platform, as well as improving existing processes through the seamless integration of transactions. A unified ledger could harness programmability to enable arrangements that are currently not practicable, thereby expanding the universe of possible economic outcomes. Multiple ledgers, each with a specific use case, might coexist, interlinked by APIs to ensure interoperability as well as promote financial inclusion and a level playing field. Absolutely massive. And if you guys have been seeing my videos over just today and the past couple of days, we've been covering this to a T. So let's go through it. Introduction. Throughout history, developments in the monetary system and society at large have been closely interwoven. This interplay has been a story of one side pulling the other, leading to dramatic leaps in economic activity over time. On the one hand, the evolving needs and demands of a society have spurred the monetary system to adapt. On the other hand, key innovations in money and payments have unleashed latent demand for new types of economic activity that have led to dramatic spurts of economic growth and development. The rapid expansion of trade and commerce over the past 500 years would be scarcely imaginable if buyers and sellers still had to cart around heavy chests full of metal coins to pay for goods and services. The advent of money in the form of book entries on ledgers overseen by trusted intermediaries opened the door to new financial instruments that bridged both geographical distance and the long lags between the delivery of goods and settlement of payments. With the advent of the electronic age, paper ledgers became digital, adding impetus to the dematerialization of money as well as claims on financial and real assets. Electronic bookkeeping accelerated paper-based processes, allowing accounts to be updated at the speed of light. Through dematerialization and digitalization, the interplay between money and the economy has wrought profound changes on society at large. Today, the monetary system stands at the cusp of another major leap. Following dematerialization and digitalization, the key development is tokenization, the process of representing claims digitally on a programmable platform. This can be seen as the next logical step in digital record keeping and asset transfer. Tokenization could dramatically enhance the capabilities of the monetary and financial system by harnessing new ways for intermediaries to interact and serving end users, removing the traditional separation of messaging, reconciliation, and settlement. Tokenization could unlock new types of economic arrangement that the frictions inherent in the current monetary system have hitherto made impractical. Guys, we literally cover this in our free crypto accelerator course on stargate-ventures.com website here. Let me pull it up, because if you're not kind of in touch with what's going on or where we've been before and where we're at now and where the future's headed, this is spelling it out, but you need more of a backstory. So go to stargate-ventures.com, go to education and software here, and go to that free crypto opportunity, a crypto accelerator course, absolutely free. And this is going to catch you up to speed if you don't feel like you're already caught up to speed with where we're at in the world with the monetary system, financial system, and where we're headed to, because we cover it all in here, and it's going to walk you through in a step-by-step order, get you caught up to speed. I'll put the link in the bio as well too. But let's keep going on this, because we have crypto and decentralized finance had offered a glimpse of tokenization's promise, but crypto is a flawed system that cannot take on the mantle of the future of money. Not only is crypto self-referential with little contact with the real world, it also lacks the anchor of trust in money provided by central banks. While stablecoins have mushroomed to fill this vacuum by mimicking central bank money, the implosion of the crypto universe in the past year shows that there's no substitute for the real thing. Away from crypto, efforts by commercial banks and other private sector groups have explored the capabilities of tokenization for real-world use cases, but these efforts have been hampered by the silos erected by each project and the resulting disconnect from other parts of the financial system. And these projects also lack integration with tokenized versions of the settlement asset in the form of central bank digital currency. Holy shit, this is a massive document. But the collapse of crypto and the faltering progress of other tokenization projects underline a key lesson. The success of tokenization rests on the foundation of trust provided by central bank money and its capacity to knit together key elements of the financial system. This capacity derives from the central bank's role at the core of the monetary system. Among its many functions, the central bank issues the economy's unit of account and ensures the finality of payments through settlement on its balance sheet. Building on the trust in central bank money, the private sector uses its creativity and ingenuity to serve customers. In particular, commercial banks issue deposits, the most common form of money held by the public. Supported by regulation and supervision, the two-tiered structure preserves the singleness of money. The property that payment is denominated in the sovereign unit of account will be settled at par, even if they use different forms of privately and publicly issued monies. While the current monetary system has served society well, pinch points in the system that emerge from time to time highlight the frictions that users chafe against. These frictions result from the current design of the monetary system, where digital money and other claims reside in siloed proprietary databases located at the edge of communication networks. These databases must be connected through third-party messaging systems that send messages back and forth. As a result, transactions need to be reconciled separately before eventually being settled with finality. During this back and forth process, not only do participants have an incomplete view of actions and circumstances, but the uncertainties and misaligned incentives preclude some transactions that have clear economic rationale. While workarounds such as collateral or escrow can mitigate such frictions, these solutions have their limits and create their own inefficiencies. Tokenization is a more fundamental route towards addressing the shortcomings of the current system. New demands are also emerging from end users themselves as advances in digital services raise their expectations. Indeed, these emerging demands may be just the tip of the iceberg. As services delivered through smartphone apps make deep inroads into people's daily lives, users expect the same seamless operation of the monetary and financial system as the seamless interactions of apps on their smartphones. So these demands are beginning to outgrow the siloed domains and their reliance on the to and fro processes at the edge of the network. So this chapter presents a blueprint for a future monetary system that harnesses the potential of tokenization to improve the old and enable the new. The key elements of the blueprint are CBDCs, tokenized deposits, and other tokenized claims on financial and real assets. The blueprint envisions these elements being brought together in a new type of financial market infrastructure, FMI, a unified ledger. The full benefits of tokenization could be harnessed in a unified ledger due to the settlement finality that comes from a central bank money residing in the same venue as other claims. Leveraging trust in the central bank, a shared venue of this kind has great potential to enhance monetary and financial system. A unified ledger transforms the way that intermediaries interact to serve end users through programmability and the platform's ability to bundle transactions. A unified ledger allows sequences of financial transactions to be automated and seamlessly integrated. This reduces the need for manual interventions and reconciliations that arise from the traditional separation of messaging, clearing, and settlement, thereby eliminating delays and uncertainty. The ledger also supports simultaneous and instant settlement, reducing settlement times and credit risk. Settlement in central bank money ensures the singleness of money and payment finality. Moreover, by having everything in one place, a unified ledger provides setting in which a broader array of contingent actions can be automatically executed to overcome information and incentive problems. In this way, tokenization could expand the universe of possible contracting outcomes, and the unified ledger thus opens the way for entirely new types of economic arrangement that are impossible due to incentive and informational frictions. The eventual transformation of the financial system will be limited only by the imagination and ingenuity of developers that build on the system, much as the ecosystem of smartphones apps has far exceeded the expectations of the platform builders themselves. Even in the near term, a unified ledger could unlock arrangements that have clear economic rationale. Possibilities include new types of deposit contracts that bolster financial stability, improvements in supply chain finance, and new ways to improve the financial system's resilience and integrity. The unified ledger concept can be broad or narrow, with first instances likely to be application specific in scope. For example, one ledger could aim at improving security settlement, while another could facilitate trade finance and supply chains. Tokenized forms of money would figure in each ledger to provide the transaction medium. Each unified ledger would bring together only the intermediaries and assets required for each application. The scope of a ledger will also determine the relevant players that must be involved in the governance arrangements. Separate ledgers could be connected through APIs, or as their scope expands over time, they can incorporate additional assets and entities or merge together. Some of the benefits envisioned from the unified ledger could be reaped by interlinking existing systems through APIs into a network of networks. What did we cover in the Holy Grail, guys? While such a network of networks would still consist of separate systems and fall short of fully pledged programmability across systems, the worst drawbacks of silo systems could be mitigated. The next stage in the financial systems journey will be one that combines the best efforts of both the private sector and the public sector. Central banks could work with regulated private entities to develop technological solutions and standards to meet specific use cases. With their public interest mandate, central banks are best placed to establish a common venue for each use case by interlinking with the monetary system. In embracing evolution and change, central banks and the private sector should follow key guiding principles to ensure that the monetary system harnesses innovation for the public interest. First, the tried and tested division of roles between the public and private sector in a two-tiered system remains the cornerstone. And then the second principle is upholding a competitive level playing field that promotes innovation and financial inclusion. And the third, the future monetary system needs to meet the highest standards of data security and privacy while ensuring system integrity by guarding against illicit activities such as money laundering, financing, or terrorism or fraud. The rest of the chapter introduces the concept of tokenization and how it could be mobilized in the design of key elements of the future monetary system, CBDCs, tokenized deposits, and tokenized claims on financial and real assets. The chapter then proposes unified ledgers to integrate these components seamlessly, and concrete examples show how this kind of integration can improve the old and enable the new. The final section discusses high-level guiding principles on scope, governance, incentives for participation, operational resilience, and privacy. There we go, man. There we go. Accelerating, heating up. It's going to be a hot summer. So let's keep rolling through. And we're going to skip this for now. So many interesting real-world applications require the tokenization of assets that currently exist in traditional databases. These assets could range from financial securities whose ownership is recorded in securities depositories to real assets such as commodities or real estate. The tokenization process for such assets occur through so-called ramps that define a mapping between assets in traditional databases and their counterparts in tokenized form. The assets in the traditional database are immobilized or locked to serve as collateral that backs the tokens issued on the programmable platform. The locking of the assets ensures that the transfer of their tokenized counterparts guarantees the transfer of the underlying assets. Central bank digital currency and private tokenized monies. The full potential of tokenization needs a monetary unit of account that denominates transactions as well as the accompanying means of payments. In crypto, stablecoins that reside on the same platform as other crypto assets perform the role of the means of the payment. However, for reasons highlighted already, central bank money and the settlement finality that it brings is much firmer foundation for tokenization. The full potential of tokenization is therefore best harnessed by having a central bank money reside on the same venue as other tokenized claims. This is because programmable transactions can incorporate settlement using the economy's unit of account as an essential part of the tokenized arrangement. For this reason, the development of a wholesale CBDC is core to the functioning of a tokenized environment. As a tokenized means of settlement, wholesale CBDCs would serve as a similar role as reserves in the current system, but with the added functionalities enabled by tokenization. Transactions in wholesale CBDC can incorporate all the features such as the composability, contingent performance of the actions mentioned above. BIS Innovation Hub, in partnership with central banks around the world, stands at the forefront of experimentation with CBDCs and tokenization. Bam. Then we have retail CBDC, which would be used for ordinary users, right? Enhanced digital representation of central bank money could include a retail variant. A retail CBDC is a digital version of physical cash that can be used by households and firms for everyday transactions by providing the public with a ready way to convert alternative private digital monies into digital cash. A direct link to the sovereign unit of account in a digital form, the central bank would further support singleness. So as we go down, with the role of CBDCs in a tokenized environment is clear, there's greater room for debate concerning the appropriate form of private tokenized money that complements CBDCs. There are currently two main candidates for private tokenized monies: tokenized deposits and asset-backed stablecoins. Both represent liabilities of the issuer who promises customers they can redeem their claims at par value in the sovereign unit of account. So there we go. Tokenized deposits could be designed to resemble the working of regular bank deposits in the current system. They could be issued by commercial banks and represent a claim on the issuer. Like regular deposits, they would not be directly transferable. Central bank's liquidity provision for settlement would continue to ensure smooth functioning of payments. As we go down here, you have dotted lines know your customer boundaries. The red rectangles indicates the liabilities. Okay, so let's see here. Let's talk about wholesale CBDC. So simultaneously settling the payment through a concurrent transfer of wholesale CBDC. Let's go down. Tokenized deposits would not only preserve, but at times enhance some key advantages of the current two-tier monetary system. Let's go down. Then it goes into a bird's eye view of some BIS Innovation Hub projects on CBDC and tokenization. You got Helvetia, Jura, Genesis, Dunbar, Enbridge, Dynamo, talking about all the different use cases. Huge, absolutely huge. Second, payments in tokenized deposits settled in wholesale CBDC would ensure finality. If we keep going down, we have third, tokenized deposits would ensure that banks could continue to offer credit and liquidity in a flexible way. And then talks about stable coins and private tokenized money. So then it gets into achieving seamless interoperability through unified ledgers. The potential of tokenization lies in its ability to knit together transactions and operations that encompass money and range of other assets that reside on the programmable platform. Money in tokenized form provides the essential means of payment that mirror the underlying economic transactions. At the heart of the system lies central bank money in tokenized form that facilitates settlement finality. So then it outlines the concept of a unified ledger. And in simple terms, a unified ledger could be considered a common venue where money and other tokenized objects come together to enable seamless integration of transactions and to open the door to entirely new types of economic arrangement. The concept of a unified ledger does not mean one ledger to rule them all, but a sole ledger that overshadows all other systems in the economy. Depending on the needs of each jurisdiction, multiple ledgers, each with a specific use case, could coexist. APIs could connect these ledgers to each other in existing systems, and over time they could incorporate new functions or merge as overlaps and scope expand. The scope of a unified ledger would also determine the parties involved in each of the ledger's governance arrangements. Here we go. A unified ledger combines tokenized money and assets on a common platform. By doing so, it enables programmability, composability, and multi-asset atomic settlement. On the road to a unified ledger, an immediate solution would be to integrate legacy systems and existing infrastructures with new programmable platforms through APIs. And APIs can interconnect systems and implement ramps that lock assets in traditional ledgers and unlock them in programmable platforms. If it's well designed, APIs may guarantee settlement finality as conventionally defined. However, because APIs involve multiple systems with different operators and protocols, API implementations cannot achieve atomic settlement. And then Graph B shows 3 different models that range for the unified ledger. But if we keep going down, clearing and settlement of payments are achieved using traditional accounts at banks. And via the conventional settlement system, a real-time gross settlement system, a set of APIs coordinate workflows by sending and receiving messages across systems. The operators for both systems establish the standards for APIs. Settlement finality is achieved in the usual way. However, in this model, atomic settlement involving transactions with private money, central bank monies, and other assets would not be feasible. So then it gives some options. Standard APIs enable interoperability between old and new systems, payment messaging model, private tokenized ledger model, fully fledged unified ledger. But the creation of a unified ledger would require the introduction of a new type of financial market infrastructure. And then if we keep going down, weighing the pros and the cons, okay. So it's talking about the building blocks. So it talks about how for cross-border payments involving different currencies, there's also foreign exchange settlement risks, namely the risk that one party to a currency trade fails to deliver the currency owed. A unified ledger could improve the way payments are executed. Having private tokenized monies and CBDC on the same platform, and eliminates the need for the sequential messages across siloed databases. And this enables so-called atomic settlement, which 2 assets are exchanged simultaneously, such that the transfer of one occurs only upon transfer of the other. And the wholesale leg of the payment from one intermediary to another also occurs instantaneously in wholesale CBDC. And if we keep going down, talking about streamlining security settlement through a unified ledger, so much, trillions and trillions of dollars. Use cases enabling the new, talking about smart contracts, how they'd be used, talking about using it in trade finance, talking about the Internet of Things, talking about using it for real estate collateral values, and talking about how it could improve the issuance of investment in securitized assets and bonds. One example is mortgage-backed securities, which pool mortgage loans into tranches of debt that are subsequently purchased by investors. Token could integrate real-time data on borrower repayments and how they are pooled and distributed to investors, further reducing the need for intermediaries. And then another use case is in green finance. The BIS Innovations Hub Project Genesis illustrates some of the benefits of tokenization and smart contracts with green bonds, how far carbon emissions are being reduced as a result of the investment, and the investor can sell the bond in a transparent secondary market. If you keep going down, guided principles talks about scope and governance, talking about supporting the singleness of money by providing settlement in wholesale CBDC. And then if we keep going down here, basically it's saying, it's easier to tokenize when there's clear regulation, clear legal framework, and streamlined processes with little manual intervention. It's harder to tokenize when there's complex regulation, complex legal framework, and fragmented processes with manual intervention. Saying it needs to be cyber resilient. And then conclusion here. So to realize the full benefits of innovation in money, payments, and a broader range of financial services, it is crucial to have a vision for the future monetary system and for the role of central banks in driving innovation to meeting evolving needs. Given the unpredictable nature of innovation, the focus should be on building a monetary system that is adaptable enough to support safe and sound innovation by the private sector in any way, shape, and form that this may take. This chapter has presented a blueprint for a future monetary system that harnesses the transformative potential of tokenization to improve existing structures and open up new possibilities. This blueprint has sketched out a new financial market infrastructure, a unified ledger that integrates CBDCs, tokenized deposits, and other tokenized claims on financial and real assets in one place. A unified ledger has 2 key advantages. First, it provides a venue where a broader array of contingent actions and financial transactions can be seamlessly integrated and automatically executed. In this way, it enables simultaneous and instant settlement. In contrast to the crypto world, settlement in central bank money ensures the singleness of money and the finality of payments. And second, by having everything in one place, it allows new types of contingent contracts that serve the public interest by overcoming obstacles associated with information and incentive problems. The ideas behind the unified ledger show how the future monetary system might evolve. In practice, the specific needs and constraints of each jurisdiction will dictate which applications of the concept will take root first and on what scale. Along this journey, multiple ledgers, each catering to specific use cases, could coexist and interconnect through APIs to ensure interoperability. Crucially, this journey requires a shift in emphasis from individual experimentation to joint collaboration and innovation. Public-private collaboration is essential to develop technological solutions, establish common platforms, and ensure proper oversight and supervision. Through cooperation, innovation, and integration, it is possible to pave the way for a monetary system that builds on trust, enables new economic arrangements, and enhances the efficiency and accessibility of financial transactions and responds to the evolving demands of households and firms. Bam, bam, bam. There we go. So we got the official news. We broke it. It was 7:43 a.m. Right now is June 20th. This came out maybe about like 10 minutes ago. And this is lengthy. This is lengthy. But as you can see, we're seeing so many things roll out back to back here. We got the unified ledger by the BIS released today. We have the IMF advisor sees power in global ledger, unified ledger that works with CBDCs. And in this, they literally, XRP has been pitched as such a bridge cryptocurrency for a settlement asset for this multi-currency cross-border payments platform utilizing CBDCs, right? So that's it. Subscribe, hit the notification bell, leave a comment. You seeing what I'm seeing? You smelling what I'm smelling? Let me know. Subscribe, share this with everybody you know, and join the Discord. Link is in the bio. And also come join that accelerator program. It's free. It's right on our website. I'll put the link in the bio. Get caught up to speed with all these things. And definitely watch the video about the Bancor if you don't already know about it. So that is it, guys. I'll see you guys in the Discord and in the next video.